The results are in. Yes, the biggest stock in the world has seen a sales decline for the third quarter in a row, and stock is falling after hours. But don't worry, there are some positives such as Amazon helping to counteract that fall at this stage, and it makes it really interesting coming into this non-farm payrolls. There are some signs that maybe there are certain businesses starting to see a little bit of problems. CarGurus stock sinks 10% after the online marketplace literally said they're delaying their report. And of course, we have a Fitch downgrade. What happened in the past in 2011? Again, today we'll be looking at the similarities from that to now. And what does that mean for charts? Well, volatility is spiking into August, the most volatile time of the year. Semiconductors teeter on the potential breakdown, which is the most important sector in the markets, and treasuries are just getting smashed. So where's the next stop for these? That and more coming up in today's show. Well, welcome back everybody to the Daily Show where we cover macro, leading indicators, and the hottest charts. We'll be covering stocks, commodities, and cryptos, but let's get into rotation. It was a day that was poor for utilities, and clearly there were some signs of weakness in semiconductors, while others are having a pretty good session. Now, what does this mean? Well, remember in the previous video, we talked about 2011. Generally speaking, there was a significant decline after the S&P downgraded the US. And it was in the tune of anywhere between 8 and 10% from that period. We also know that gold tended to do well there, and treasuries reacted in a very different way. But this time, they're certainly selling off. We'll talk about that later on today's video. Now we've got two bits of news moving forward. Remember, volatility, you might think Apple and Amazon are done. It's all the bad news or all the news is out of the way. Well, not quite yet. We most likely have a very interesting US CPI next week, 10th of August. Make sure you're around. The one thing that's really been showing here is diesel prices tend to track CPI inflation. And according to the Bank of America, diesel prices have been increasing. I think we all know that oil is up big time, and it is expected now to probably be the last really good CPI figure for this year. In terms of we may actually be seeing a rising CPI. What will the markets do if that does become the occurrence? Surging demand for calls. We talked about this chart many times, and it really just shows us that we hit peak FOMO potentially, according to sentiment reports as well, around the 19th of July. And inflows have been really from the big guys moving into smaller stocks. The US 2000 has had some of the better inflows over the last month. And we can see that in price and also the way that the market's been selling off. So remember the 19th of July? Well, it turns out that's so far the peak of the NASDAQ. And we know that the sentiment reports are kind of showing that type of sign. If the markets are going to sell, this is the time for them to do so. And that's because it's a mixture of August into September, the two weakest months of the year. But if you're a bull in markets, is that something to worry about? Well, if you're an investor or a longer term setup merchant, not really. We remember this stat here. If the markets fall over 10% or anything like that, it would usually be a buy opportunity. You can see in previous history, August and September, while they are the weakest months, and one of them is always usually down, you can see they kind of flip-flop. If August is up, 6 out of 6 times, September would be down. So really, it's the next 2 months, but it's 17-1 in terms of bull ratio by the end of the year. Let's move through some unusual volumes. We've got some big trades. The first one was, of course, what we saw on the Qs. Well, so far, that's led to selling. And, of course, these are significant positions. But I can tell you that over the last 24 hours, there were some closes on our 3x leveraged funds. So basically that means that people were looking for the day trade or the scalp, the big players. They've most likely exited their shorts over the next 24 hours. Does that mean that markets will rally here? Maybe it can, but certainly the big kind of leverage day trading, couple of day sells, those ones are most likely out. Another one that just has kind of shown itself has been USO, which is, of course, United States Oil Fund. That just saw a big sell. Most likely it's a sell because it's been rallying into this level. And it makes sense also to the type of area that we're in oil, which we'll be looking at later on today's show. So let's jump into the data now and talk about pre-election years. You can see the seasonal volatility trend, if you haven't been watching the channel for a while, is expected to rise here. Yep, it is. Maybe not at that extreme, but it certainly is going up. We also know that the seasonal volatility taken over 33 years tends to climb steeping higher, and then around middle of October during most years you see it decline. That's where you get that turn in the market as well. So if we are going to follow pre-election years, it's going to look something like this. Maybe a sell into August, then a bit of a rally, a sell into the back end of September, and then October, November, December being positive. That is if we follow the same trend. And by the way, we have been, just to a greater percentage this year, we're following pretty much the same as the pre-election curve at this stage. And this is, of course, where we expect that weakness to occur. And it could be off the back of so many different things. The big earnings are in now. Amazon, Apple have announced. And of course, this brings us to the end of pretty important week. Basically around here, by the end of this week, around 80% of the market cap of the S&P 500 has now reported. So in general, earnings season is kind of over. Now we move forward to the economic data, the non-farm payrolls and other numbers such as that. Do remember to still keep your economic calendar if you're trading stocks such as Nvidia and others, as they report quite a lot later on. But I think that we've kind of seen what we need to know. And it was a okay earnings. The beat rate is 68%, beats 1261, misses 582. I'd call it slightly under normal, but basically right flat bang on. And this means that the market is only going to sell if it just has decided it's a buy the rumor, sell the fact after the event, or they get started getting spooked about the future due to some of the other problems that we'll look at on the charts. Let's look at some unusual trade volumes over the last 24 hours. What were some of the big ones here? We did see a huge trade on PayPal, which of course happened after the earnings. Look at PayPal fall. Luckily, we had our TP zone 1 into earnings. This is why sometimes I don't like taking hyper stocks into earnings at the moment. 4.07 versus 90-day volume. You've also seen huge trades here. You'll notice ZOP, SPDR, S&P oil and gas exploration and production up 2.1%, but a 4.27. So quite a lot of trade there. Qualcomm also coming under a lot of fire with a huge amount of options trades. And there's a few others that have been, kind of showing themselves. J&J and Pfizer have been in this list for a while with very little moves. So we might need to look at those charts moving forward. Moderna is another one that's just fallen through. This stock is getting slaughtered at the moment. And I do believe we'll be putting those on the charts later on. So make sure to subscribe if you're interested in that, as we kind of cover maybe an underappreciated sector at the moment that could turn at any point. It's kind of going into capitulation. Today's total options value was basically smack bang on. We're still seeing everyone buy the dip. If markets used to fall, we'd see puts outweigh the calls. Now it's calls outweighing the puts, which does open the possibility of further sells. Last 24 hours was not very defensive. Both healthcare and utilities made up the bottom of the list, staples in the middle, and it was an energy day. And again, more of the kind of, I would say CPI related stocks, things like financials and energy. They've been the ones that have been actually doing pretty well on the charts recently, and you can see that that's been occurring. So just before we jump into the charts and we take a look at all of the hottest levels that you need to be watching right now, I want to say a big thank you to the sponsor of today's video, which is Tiger Brokers. Now, not only are there special offers down below, but I want to talk about this earnings season. Whether you're looking at the Australian market, the American market, or something else, being able to select a watch list or your positions that you have open is really handy. And you do not want to miss out on, of course, any earnings, because it can mean lost money in your account or potential opportunity. Daily, weekly, monthly views, something that sometimes they don't have in platforms. They do have it in Tiger. And do remember that their platform is available both on Android, iOS, and every single pretty much compatible thing you can think of. Over here on the right-hand side, what have we got going on? Well, we've got premium news as well. To be able to have some of these news feeds at the touch of your fingertips, and more importantly, in a feed itself that refreshes, is excellent in earnings season. And also, don't forget to overlook things like sector rotation this earnings. We've already started to see a little bit of a pickup in defensives and a potential sellout of semiconductors. Can you see that? Well, you certainly can when you look at heat maps such as this. So what are you waiting for? Check out the option links down below. And if you're looking at a special offer, there might be one right for you. All right, well, let's jump into the charts and look at all the key levels we need to be watching into this non-farm payrolls. And do expect it to be relatively volatile, because we've been coiling on things such as the US 2-year. Whether it's this non-farm payrolls, the unemployment numbers in the US, will it cool, will it not? I don't know which way it's going to go yet, but we do know that 5.1% will be an alert that we should set on the US 2-year. And if markets go into the unknown on yields, do expect things like maybe gold to weaken at that point. And also, I would expect the same thing of really markets showing incredible volatility and suddenly going bearish. 5.1 will be the bearish signal in my opinion. JP 10Y 0.65. This is starting to come into the upper bound of what the Bank of Japan was talking about. And I do think there's a catalyst here. So remember to set your 0.7s, your 0.8s, and they've allowed up to 1%. But I think in reality, if it gets there really quickly, the Bank of Japan will be in all sorts of trouble. And this could be just like that kind of in plain sight, black swan style event that could cause some issues around the world. Don't sleep on that one. We will do a special video on the weekend on it. RSP, the equal weighted market, has it been holding up? Has it been selling? It's sold back off to, of course, the first level of demand or support. So yeah, RSP is basically on a potential buy zone if the dip buys come in. This is the one though that's worrying some people, and that's Treasuries. Treasuries has fallen 3 days straight. It went through the 75. It's almost at our second target, which is 94. And then the third target is 90. I really like 90. I think it's an exceptional level for Treasuries. And I don't mind if it goes down there. Now, of course, this is not a trade. And Treasuries is, in my opinion, not really that great a trade. It's generally more of an investment or multi-month philosophy. I think it could go down to 90. And the main reason is it would sweep the lows, freak everybody out. And it's kind of doing the opposite of what happened initially during 2011, which is where if you go back to 2010, 2011 and think about it, we actually got that kind of increase in Treasuries after all of this news. This level though, look at that. Look at that $90, $88 to $90. It's a phenomenal demand zone. And I'm watching very closely how Treasuries trade. So we'll continue to watch it. Another one of the bonds that we'll be watching here is going to be high yield junk. High yield junk has not really recovered. In fact, it was down on the session and didn't bounce. So if the market starts bouncing and high yield junk stays here or goes down, yeah, I'm going to say it's a false rally. And we're watching high yield junk very closely. Island reversal up here, putting pressure now and starting to come down to 73.47. If it breaks below that, yeah, we know that that's going to be pretty negative for the markets. And the bonds market is certainly turning a little bit more than the stock market at this stage. Something we are watching. Another thing we're watching is consumer discretionary versus staples. Now, post-market, thanks to Amazon in part, we've seen 2.29, so it's actually gone up. If this starts to keep falling off though, as of real trade rather than just post-trade, then we know that the market's turning defensive. This is a third of the US economy, the American consumer, and it's pretty important to see that on the chart. Always keep that there if you can. Magma, no real change, no change of trend. We'll come back to that when necessary. Weekly close on copper will be important. Long leg doji at the moment. Non-farm payrolls will mix this. I don't think we've got too much edge there at this stage. It just looks like it's at the top or kind of at the bottom. It's long leg doji. And US oil is back at the point where if sellers are going to come in, this is around the right area. We saw a small change of trend here. We also saw a small change to the upside. Markets rallied into this zone of extremes, and I think they're waiting for the non-farm payrolls. But I did see the news coming out, and I believe some of the OPEC countries have said, yes, we commit to keeping barrels low. It's so funny. It's such a manipulated market. It's just ridiculous. We'll change the barrel amount, and then you guys still want to trade it. Yeah, right. So here's the supply, and here's the level that we're looking at. So if it's going to weaken, this area in here, stops above those will be the interesting zone. And at this stage, of course, it's been a big rally. But you can't tell me that's not going to affect the CPI numbers. And then even though it's in plain sight, maybe not enough people are talking about it. We'll find out. We'll keep covering it into next week's numbers themselves. The dollar, the US dollar, very strong. Some signs of turn. We got a new low. Rallies could be met by sell demand at this point for the dollar index. This is the second turn we've seen through this run over the last little bit. So certainly a significant day here for non-farm payrolls. I could see it easily spiking a high and then going down. Patience, react, don't predict. Non-farm payrolls often goes off in one direction to grab liquidity, and then it will go off in the opposite direction. Be very careful about this. It particularly moves gold, dollar. These types of pairs tend to trade very heavily off non-farm payrolls. And speaking of gold, it's at our buy zone theoretically. So we still continue to hold here. Now, I'm pretty sure non-farms is going to give a trade. I just don't know the direction yet. So again, patience is going to be key. If the market instantly goes down, hits into this level, then rallies back above 1940, I'd be bullish on that particular trade. If the market then goes up, hits 1950, then sells and takes a new low, I'd be bearish to the next level. But really, it's going to be a react game here on gold. We know it's at a good zone. We know this is where we expected gold to get to. It has been there. I'm looking towards the bull side for gold, so I'd like to see gold actually start stacking a little bit on during this like kind of more heightened volatility and all of those things. But at the same time, this will be where the decision is made. And stick around as well for our weekend video as we take a look at the flow inputs. Have the bigger traders continued to buy gold big time through this drop? We'll be watching, we'll be looking, and of course, we'll be seeing whether that's true or not. Central bank liquidity is basically still flatlining down the bottom and big discrepancy between the Qs. We know this is not the full story, but yeah, it's still unusual and it is time for probably some kind of pullback. Now we get the market that probably matters the most. AAPL, the biggest stock in the world. Is it through the daily 20? It is the first fall in all of this run since the breakout where we've got a red candle underneath the 20 moving average. That doesn't stop the market from rallying initially, but in general, that's a pretty bad sign. Post, of course, we're going down to 186.86. I wonder why we're there. The previous support. The market's moved directly into pressuring that support. And if it gets through there, it's basically saying that we've got a high, a low, a high, high, and we've broken trend, and we're probably looking at swing weakness for Apple. Kind of like a buy the rumor, sell the fact here in this one. Fairly significant chart, probably something we will now watch every single day of the next week. Amazon, on the other hand, was much better. This came down to the demand before earnings, and it knocked the lights out. Look at it, post action 141. We'll be looking at whether it can hold that. So that's going to be a big thing. Where does it hold its weekly? We can see here with the weekly wicks that there was a little bit of ejection coming on this demand. So you can see all those weekly wicks. That's probably telling you that someone was buying that level fairly aggressively. I always say loose lips is a thing in the markets in Wall Street, and clearly someone knew because otherwise they wouldn't push it. My thought is probably 144-ish or just underneath 144 is where Amazon's going next. Then maybe it finds weakness again. But if you've held Amazon as an investment, congratulations. It did hit my TP number 2 for a trade, which is of course here. And my TP number 1 was down here. This would be my TP3 and TP4 if I was holding. However, as an investor, I still think Amazon's relatively cheap. I wouldn't have a problem at all. And I still think they'll benefit heavily from AI, and maybe they've been a slightly underappreciated stock in that aspect. Let's move over to Tesla. It broke low and now it's coming back to retest. No real trade here that's really great. I mean, if anything, I would probably say 240 is the move because it broke through that coil, but the momentum has been pretty lackluster. So yeah, around here is where I would expect Tesla to short if it's going to. Pretty lackluster trade, but that's where we're at. CQQQ, the Chinese market, bounced heavily off our trend line and our key level. This is pretty nice. I still like CQQQ. Nothing really changes here. I think October will be the bazooka for stimulus. That's just my guess. During the party conference stuff, I think it's already looking pretty good. And we've talked about this at great length about the inverse head and shoulders, the fact that it's super under where it was, and it's kind of like a hyper stock at this stage. Again, place your own risk parameters and all of those types of things. You've got to be careful out there, but yeah, it's something that it does look good on the charts, at least for potential. Let's go over here in terms of high, low, higher, high. We saw that the German market made what we think is a UTAD now, based on the fact that we broke underneath 16,000. It has to be that rallies are met by sell demand at this stage, and it's another one of those signs saying that this could be a more significant, mean reversion style sell-off, because the market's set up in such a way that it's got all those kind of trap events. We, of course, thought there was a sell here. Yeah, there was. It hit 16,000, rebounded. That ended up being a break-even trade, unfortunately, so there was no entry. That was great. Here we see a big takeout, which is that UT, and buyer's climax over here. And it looks very similar to a Wyckoff distribution. So yeah, I think it's looking weak. Doesn't present that well on the charts. The US 2000, how's that going? Well, you can kind of see down here, it's doing pretty well. It's holding above that key 1947. If that gets taken, that's all three major indices weakening. So that could be maybe a very important point when we take a look at this buy the dip style scenario. Another thing that a few of you have been mentioning is where's the Australian market? Let's take a look at the Australian market. And it is trading right smack bang around this kind of demandy zone. You can see it's actually put a double top in now. So what happened was we broke out of the range. We've done a double top, which is usually the end of a trend. So this is the end of trend and then the start of maybe a new one. The problem with the double top is you don't really know how much longer it's going. So I liked our ASX 200 from bullish here to here. Then it broke out. Then it's had a lot of confusing style candles on the futures. We'll look at it on our weekend video as we bring it back. But at the moment, you'd have to say it's weak based on the double top, based on the breakout in the last 24 hours. And it's kind of, showing itself to be very susceptible to the inflation trade. So, of course, if banks start failing or energy starts selling off based on that USO, then all of a sudden we're going to probably go back down. So just be careful there. NASDAQ, you can see here on the weekly what it's done. Interesting and very important weekly close. If it does close below the lows and below the daily 20 and all these types of things, it'll be a big deal. If we zoom in a little closer, you might notice the candle. It is a long leg doji, a high, a low, an open, and a close at the same level. What's that mean? It has no idea what it wants to do next. It's happy where it's found itself. Why? Because it's waiting for non-farm payrolls, and then we'll probably get a bit of a move. Remember, if the market does take the low, it would most likely at some point rally back up to that doji, allowing for a short entrance. Again, patience, react, don't predict is something that's pretty key here in these markets. But look, it's through the daily 20. It looks weak. This is the worst action on the price that we've seen since the breakout, which basically means it is the weakest period that we've seen the market for about 4 months. And it's at the right time in the right place with the right amount of volatility. Next stop for the sellers would be somewhere around that 15,000 flat, so losing about 400 points. And I do think there'll be some buy the dip people that'll come through here. Fairly well traded zone. Again, we'll look at it on the weekend, but non-farm payrolls may push it through. The S&P, let's take a look at this one. So again, kind of like a long leg doji. It's broken underneath. It's kind of showing you that maybe even with this long leg doji, that it wants to get at least 440, so 4440 or lower to get back into this area. Give us a little bit of a sell-off, a little bit of volatility in this time of year. If we go to the US 500 futures, you'll see they closed underneath the daily. Again, this is significant because since the 4200 breakout, we haven't seen that happen. This is the weakest market, again, we've seen in a while. And while I do think rallies could happen, I'd be looking at sell demand. Let's take a look at both scenarios, though, on the 15-minute chart. So as I was saying in our private community last night, what we were looking for here, there are some significant turns, actually, that have just happened here. So what we were looking for was this level to be broken if we were going to be bullish. Otherwise, we wouldn't be. Now we've got a low, a low, a low, and a bit of a switch. So on like a 5-minute, 15-minute chart, you would actually say that this market just hit a buy zone and that it would be buy the dip. There are some problems, of course, as it returns back to the high, which it's already done here. You really should be looking at, okay, saying, well, my entry down here, especially if it goes back up again, should be broken even due to, the controls. But yeah, stops, basically looking at that holding, this level being put under pressure, which is around 45.30. Let me just quickly check. 45.33 or something. And even then, if that rallies, I'd be very cautious around 45.65, I think is the level, 65.66. Around in this supply here is where I could see sellers recommit to this trade and basically say, okay, well, we're going to push it down. So there are both bull and bear case scenarios. I just don't know whether the bull will be able to hold to a new high. Instead, this is where you would expect, though, a little bit of uptick. So it does look okay coming into non-farm payrolls. It does look like there's going to be a little bit of futures green. We'll find out whether it can hold, and then we'll go from there. But yeah, look, there's both ways to play it. On the daily, looks terrible, but on the smaller timeframes, obviously, it looks like it could be buying back up into some of these levels. And you can see why that 45.30 is so important. It's the previous low point as well. So it's where support becomes resistance, where the 20 moving average acts as dynamic resistance as well. There's a lot of confluence at that area and some issues there. Now, Bitcoin is an enigma. Did it come back to the level we talked about in the previous video? Yes. Did it buy off that level? No. It's literally sitting on it. So we said 29,259, I guess. We're trading at 29,228. I'm a little worried about the fact that it didn't bounce yet, and I would certainly be cautious on this. Remember, it's small time frame switches that are here. I would prefer it get through 30,400 to give us actually some proper injection. But yeah, Bitcoin in the buy zone, very careful. I'm not sure if it's going to hold. It shouldn't really sit for so long. It should be more of a fast reaction if it's going to be real. So sometimes you descale into such an event as non-farm payrolls. Speaking of that, it is 8:30 a.m. New York time, and it's going to be a big one. I am doing a private stream for it. If you're interested, you can join. Free day, 7-day trial. Links in the description down below. And yeah, non-farm is going to be a big number. Will it come in hot? Will it finally show the US weakness? ADP, non-farm employment change, showed a monster number. So if it comes in as a monster number, expect yields to increase across the board, put pressure potentially on gold. Maybe it'll be positive for the dollar. Who knows how it's going to react, but we do want to see reaction, and then we'll be patient. And of course, that's when you want to take that opportunity. When we go through CPI, we've got two big ones. We've got CNY CPI and of course the US CPI, 8:30 a.m. Thursday, August the 10th. Whew, it's going to be a big one, and I am excited for it. As always, if you enjoyed today's video, then please make sure to subscribe, smash that like button, guys. And remember, the sponsor of today's video is Tiger Brokers. Check out the links in the description down below, along with the special offers. Thanks so much. Bye for now.